CAMT stock just dropped almost 18% in a single day and is now sitting around $170 per share. And here's the crazy part. They actually beat earnings, they raised guidance, and demand is still being driven by AI. So why is the stock crashing? Today I'm going to break it all down, what Camtek actually does, why the stock dropped so hard, and whether this is actually a buying opportunity. And stick around, because I'm also going to give you my bear, base, and bull price targets so you know exactly how I'm thinking about this stock from here. Let's get into it. First, what does Camtek actually do? Camtek is a semiconductor equipment company that focuses on inspection and measurement tools. Basically, they help chip manufacturers detect defects, improve yield, and make sure everything is working correctly during production. Their customers include major chip companies, foundries, and packaging providers. These are the companies building the chips that power AI, data centers, and advanced electronics. And here's the key point. A large portion of Camtek's business is tied directly to AI-related demand, especially advanced packaging and high-bandwidth memory. So this is not just another random semiconductor stock. This is an AI infrastructure play, which is exactly why the stock ran up so much over the past year. Now let's talk about what just happened. Camtek reported its Q1 2026 earnings, and on the surface, the numbers actually looked strong. Revenue came in around $121 to $122 million, which beat expectations. Earnings per share also came in ahead of estimates. On top of that, management guided second quarter revenue above what analysts were expecting, and they said they expect strong growth in the second half of the year. So if you're just looking at the headline numbers, everything seems solid, but the stock still dropped almost 18% in a single day. So what's really going on here? The first reason is something called a beat and drop. Camtek had been one of the hottest stocks in the space. It had more than doubled over the past year, and it was trading at a very high valuation. So heading into earnings, expectations weren't just high, they were extremely high. The market wasn't looking for a good quarter. It was looking for a perfect quarter. And even though Camtek beat on revenue and earnings, it simply wasn't strong enough to justify that kind of valuation. When that happens, you get what's called multiple compression, where the stock drops even if the underlying business is still performing well. The second reason is the outlook. Management made it clear that the next quarter is going to be more of a transition period, with most of the growth expected to come in the second half of the year. And that matters more than a lot of people realize, because investors don't like waiting, especially when a stock is expensive. So even though the long-term story is still intact, the market is reacting to slower growth in the short term. The third reason is valuation. Even after this drop, Camtek is still not a cheap stock. It's a relatively small company in terms of revenue, but it has a multi-billion-dollar valuation and had been trading at extremely high earnings multiples. That means even small disappointments can lead to big moves down. And finally, there's macro risk. Camtek has significant exposure to China, which brings uncertainty around export controls, regulations, and overall demand visibility. So when earnings don't massively exceed expectations, investors start pricing in those risks very quickly. Now let's shift to what matters most, where the stock could go from here. I'm going to break this into three scenarios: bear case, base case, and bull case. Starting with the bear case. If the second half growth gets pushed out again, or AI demand slows even slightly, or we see more pressure from China exposure, then this stock could continue to re-rate lower. In that scenario, I think CAMT could fall into the $130 to $145 range. That's where you'd see a lower valuation multiple, less hype, and a more cautious market outlook. Now the base case. This is where the company does exactly what they're guiding. Short-term growth is a bit sluggish, but the second half of the year ramps up, and AI demand remains strong. In this scenario, the stock likely stabilizes and slowly recovers. I would put a fair base range around $165 to $185 per share. So not massive upside, but also not a broken story. Now let's talk about the bull case. This is where management fully delivers, second half growth comes in strong. AI demand continues accelerating, and we maybe even see upside from new orders or major customers. In that scenario, sentiment flips very quickly, and I could see the stock moving back toward the $210 to $230 range. But it's important to understand that bull case requires near-perfect execution and strong overall market conditions. So here's the bottom line. Camtek's business is not broken. This drop is happening because expectations got too high, growth is being pushed into the back half of the year, and the valuation needed a reset. In the short term, the stock is probably going to stay volatile. In the medium term, everything comes down to whether they actually deliver on that second half growth. And in the long term, this is still very much an AI infrastructure story. If Camtek executes, this drop could end up looking like a great buying opportunity. But if they don't, this could just be the beginning of a bigger correction. That's the risk you have to weigh. If you enjoyed this breakdown and want more videos like this, make sure to subscribe to the channel, and I'll see you in the next one.